So after showing some risk aversion for most of this week going into today, in fact, the Russell on the 6-day losing streak, stocks predictably bounced up to finish going into expiration week. That was something we really discussed quite a bit in my trading room yesterday at marketscholars.com. That was our expectation with volatility as high as it was. So we got that. And the question is the risk aversion over? What did we get a full-on risk bounce today or not? You'll find there's some pretty interesting patterns that kind of point us in the right direction. Whether it's back up, another buy the dip for another expiration cycle that we've seen the last few expiration cycles, or is this going to be kind of a really light bounce? So I'm going to show you those patterns and show you what's unique about this last dip versus the others that we've seen previously. I'm also going to show you kind of what's driving how some of these other asset classes. Are we in a pullback and we just don't know it yet? So I'm going to show you some of these other asset classes and sectors and how they're performing, what it looks like when we're in risk appetite mode, what it looks like when we're in risk aversion mode, and we'll discuss that. And then our trade idea is a stock that, despite today's rally, did not follow suit and did not have a good day. And it's in a very important sector. And we're going to talk about how it performed, what it tells us, and how to trade it. So let's go ahead and get started. Today is Friday, August the 20th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator like we always do. And you can see despite the pullback and then, of course, today's subsequent bounce, you can see the intermediate line still up above 80, still in the upper reversal zone. Same with market sentiment. Short-term sentiment is back into bullish territory, even if it's not necessarily in oversold levels, but at least it made it back up into bullish territory here. Of course, that makes sense, closing above yesterday's high, pretty much reversing Thursday's loss and then Friday's opening loss. You can see we are back above the moving average by almost 1%. Of course, 2.5 appears to be about the limit that we get up to. On that bounce off the moving average, we got up 2.5%. Here, the peak ended up being at the end of the run, almost 3%. Same thing here, the peak ended up being at the end of the run, about 1.5%. So, the idea is this year the peak was at the beginning, so I wonder if we'll get the peak at the beginning again. So it remains to be seen what kind of rally we end up getting by the time it's all said and done. If you take a look at like the Russell 2000, which is obviously a different story, you can see that it's still below its moving average by nearly 2%. The intermediate line is still in bearish territory, so we are in intermediate pullback mode. A little bit of an engulfing pattern there today. But we still have dark pink shading and a red line. Short-term sentiment did not get into bullish territory. In fact, the near-term line is still below 40. Momentum line is just barely above the midpoint of the chart. You can see how it's kind of avoided bullish territory this entire six-day losing streak that it was on. So drastic difference between what we're seeing there versus, like, say, the NASDAQ. Even the NASDAQ Composite, which came very close to another overbought cluster. Just like that. I mean, as bearish as we were to get that, oversold level, even though the near-term line didn't quite get below 20. The momentum line got to extreme lows, but the near-term line didn't follow into the reversal zone, and has since bounced back up. But just like that, I mean, we are light pink shading because the intermediate line is falling below 80, but still very bullish from that perspective. Let's take a look at the weekly market forecast for the S&P 500. So here's the weekly chart. You can see, the strength that we're seeing. We obviously a little bit of a lower shadow here this week. Not surprising when you get a little bit of bearishness. The intermediate posture is still strongly bullish there. The near-term line is still easily above 80. So nowhere near any kind of corrective move yet. The momentum line got to oversold levels over here, got to extreme lows over here, but since then the lows have been gradually higher, so less and less bearish. On the flip side, when you look at the Russell 2000, it's a little different story. Now the intermediate line is, the near-term line peaked without getting above 80. The near-term line has now made its way below 60, so it's out of bullish territory. We haven't seen that since the COVID drop, right? And over here some lows here, in 2019 as well. So it's it's not too common to get the near-term line here below 60. There was an intermediate pullback there in 18. Even the drop that we had in early part, 17. The drop we had in early 18 didn't even get the intermediate line below 60. It wasn't until the drop there in the fourth quarter of 2018 where we had that kind of market sentiment decline that got it down to low levels and ended up getting some clusters there. We ended up getting nearly a cluster there with the near-term line just barely above 20 at the 23rd percentile. It's like right there, sorry. The intermediate line would have been at the 26th percentile on that day. So very, very close to an sold cluster on that day as well. So, much different story. And you can see up here at the top, we are below the 30-week moving average. And, the moving average is now dropping. And we're not dark pink shading in a red line yet, but it's again, for us to be below the moving average like that, and closing below last week's low. In fact, closing below the last 3 weeks' lows there is pretty significant, even with the bounce that we had. You can see it's not too often we get below a 30-week moving average, but that's where we're at right now. And of course, on the flip side of that, we're not even close to it on the NASDAQ 100, which, again, on the daily chart, we were close to a cluster. On the weekly chart, we were about as close to a cluster as we've been in a while. We were pretty close on that week, on the week of July the 19th. The near-term line was at the 72nd. We're at the 77th percentile here. We were pretty close on that week as well. We were at the 73rd percentile on the momentum line. Over here, we actually came really close. The intermediate line was at the 78th percentile. So again, like the last time we got a cluster was there, and this is about as close as we could possibly be and not have a cluster. So very significant selling here. And let's take one more. Let's look at a monthly chart, but obviously not the end of August, because we're not at the end of August, but we're going to look at the expiration cycles, because we just ended an options expiration cycle. So here's where we are, and you can again see the strong bullish trends, strong near-term line on the Russell 2000, on the NASDAQ, on the Russell 2000, which look at these bearish candles that we've been getting. These are monthly candles, mind you. The intermediate line still up above 80, but you notice that near-term line, the momentum line, getting into bearish territory there. So it just kind of shows, how weak that we've been from month to month to month, from expiration cycle to the next. From an options inventory standpoint, it's been great for us on our portfolio that we've been trading from month to month. Let's take a look at some of the other charts. You can look at the weekly chart here, and you can see that we are we're in the 91st percentile of PPO over the last 5 years. If I were to zoom that out to the last 20 years, we're in the 95th percentile still. And most of the other 5% is up above where we're at, just barely where we're at. So, we are still very strongly bullish from a long-term perspective, and a little bit of a neutral candle there. If you take a look at the NASDAQ 100, a little bit more bearish than neutral. No red arrow there. So remember, keep in mind, it's a red arrow that signals that on this chart, that we're in intermediate decline. We don't have that yet, despite the neutral candles we've gotten. But you notice we have gotten that red arrow last week on the Russell and got a pretty good bearish candle there. And you can see much lower, 5% on the PPO relative to under 8 on the NASDAQ and under 8 on the S&P. So we are really consolidating pretty sharply there on the Russell 2000. Let's take a look at the 3 green arrow chart, as we like to do. So give me 1 second here to pull that up. And you can see we have 2 red arrows. Despite the bounce, we have 2 red arrows in the S&P. We have 2 red arrows still on the diamonds. We got the bounce back up here today. We got the green arrow on the Qs today as well, so we still have 2 red arrows there, but you can see the MACD histogram is rising on the S&P and the NASDAQ 100. And then if you come down here to the Russell 2000, which has been well below the 30-day moving average, you will have 3 red arrows. So the MACD is turned up 2, but the stochastics is in oversold levels, where here you're at the 50, 51, 59, 53. I mean, you're just barely under bullish territory for the stochastics, and the stochastics for the IWM is in oversold levels. When you look at the 2-line version of that chart, here you can see that the S&P 500 bounced back up today above the 17 and 8-day exponential moving averages. That's a relatively positive development, for at least in the short term, after getting close to getting a close below the 30-day moving average. You can see over here we had closed below the 17 and the 30. Here we closed below the 30 and the 50. Well, we didn't get either one of those kind of bearish moves on the S&P. The difference is what we see on IWM. So IWM bounced down below, and yesterday broke below the 200-day moving average, well below the 8-day, which precipitates this kind of move. You can see, I always tell my classes that you get your biggest bullish moves when you're below the moving averages, especially when you're pretty far below the 8-day moving average. That's when you get your biggest bullish moves. You can see lots of examples over here when you're really far below the 8-day. Well, that's what we were yesterday. We were pretty far below, but you can see, if I put my cursor on where the 8-day moving average was yesterday, you can see going to the left that all the other times that we were below and flirting with that dotted black line, which is the 23% retracement of this current intermediate run that we've been consolidating. You notice all the other times here and here and here, if I put my cursor back on that 8-day moving average, it was higher if you look at all those other times. So we had much bigger moves to get to them than what we even saw today, and today was a pretty decent sized move. This puts today's move in the context too. We've had for SPY, you notice not that big of a deal here, but if you look at IWM, we were on a pretty bearish streak. In fact, we've had a lot of red bars, a lot of down days, and a lot of opening gaps to the downside lately. So, and today's bounce is really not that much bigger. You can see over here where we had the 5-day drop with 4 of those 5 days below 1%. We bounced 3%, right? That was that move. That was, it was 720. So if you come back over here and look at IWM, you can see 720 is right there. So that was a really significant move to the upside, because we had 5 down days in a row, and 4 of them more than 1% to the downside. So we got something very similar here. We've had 6 down days in a row. 1, 2, 3, 4, 5, 6 down days in a row. In those 6 days, we closed below the 8, 17, and 30-day moving average and the 200-day, while being below the 50 the entire time. And in the 6-day run, the 8 and the 17 both fell below the 30. So now you have the 8, 17, 30, and 50 all in alignment, all still above the 200, but still all in a bearish alignment there. So that's the first time that's happened during this last little drop that we've had. And you notice again, big, let's see, SPY, but IWM, big 5-day losing streak, big down days, boom, 3% rally. Back up to the 8-day moving average, and another big move up to get to the 17-day, the next day. Here, 6 down days in a row, with again 2 of those 6 being more than 1%, but the other 3 being really darn close to 1%, and a couple really significant gaps, 1 standard deviation gaps to the downside, and we barely got more than 1.5. We didn't even get to 2, much less to 3. So again, because the 8-day moving average is lower, we're not getting that much move. So it kind of shows that we are kind of leaning more to the downside on the Russell 2000. And as you'll see here in a minute, it's not the only risk asset class that's showing a bearish patterns on its chart. So just because you're in a bearish intermediate pullback here, right here, just because you're in a bearish intermediate pullback, and you're the only one, because the other ones are light pink shading and green line, dark green, light pink green line, dark green shading, green line. This is the only one that's dark pink shading and a red line. But that doesn't mean you're not going to have up days. Like, in fact, you have your biggest up days when you are below these moving averages. That's just the nature of how this works. Let's take a look at some of the other oscillators here. Let's look at the directional movement index. For SPY, you can see, again, very, very minimal movement. So, somebody on TV said today about, in their opening that, investors have been on this emotional roller coaster, this week. It's like, holy cow. If you've been on a directional roller coaster where the ADX has been near 10, then we have way too much at risk in the markets. If this move here has sent people on an emotional roller coaster, because that is nothing, right? Nothing at all. Now, granted, holding periods are very low, so most people are in the markets right here. So, that is more volatility than what they may be accustomed to. But the reality is it's absolutely nothing, which is the scary thing. That's why, you always hear the term weak hands. At the end of bullish markets, you got weak hands because people who got in are people who got in here for the most part rather than here whenever we had our only intermediate pullback, much less people who got in here when the market started, because again, holding periods on average are like within months, well less than a year, and that was well over a year ago. So weak hands, right? And you can see also, but if you look at IWM again, you have still a very directional move, above 30 on the negative indicator, still below 20 on the positive despite today's bounce. So don't read a whole lot into that. If you look at the RSI indicator, again, we're in neutral territory in the S&P 500, avoiding bearish territory at the very least. Not the case on the Russell. The Russell is just barely back above 40, but just barely. We're still below negative 100 on there, so we're not out of the woods on the Russell, despite again today's little rally here that couldn't get us up above the Ichimoku cloud or above the green or blue lines here, and we still show a weak bearish trend developing above 50 on that. Below -1 here. If you look at SPY and QQQ especially, it's the opposite. Well, QQQ actually broke the trend. It broke the trend yesterday, which that's significant, right? That is very, very significant for that to break the trend like that. SPY has not yet, so it wasn't as bearish enough, whereas QQQ was. So, it's still above the cloud, so it's not like we're falling off a cliff here. But for QQQ to break the trend is a pretty significant development that we no longer have a trend quality above 5. We no longer have a trend noise balance above 50. They both are sitting at, they both hit 0 yesterday, and today they're both still at 0. So the positive trend has broken on the NASDAQ 100. We are now directionless, and you can kind of see over the last few weeks we have been going pretty much nowhere. It's been on a bullish bias, but we haven't been going anywhere, hence the drop there. And if you look at the Bollinger Bands, you can see there's some pretty good support down here at that 23% retracement, but we're still easily in the middle of the bands, nothing too major. QQQ, same thing, we're actually in the upper quartile of the bandwidth, very, very low bandwidth, mind you. IWM, despite the bounce, we are still in the lowest quartile. We were so far below the lower Bollinger Band. In fact, if you look at the gap between the lower Bollinger Band and the Bollinger Band and the Keltner channel, you can kind of see that we were below the Keltner channel too, and below that 23% level, bouncing back up. You notice the bands are still inside the Keltner channel, so we're still red dots down here, but that bearish momentum is finally starting to pick up. There. We haven't seen that for a while because we were in this bullish run. Now we're starting a bearish run, flirting with breaking that, and so that's definitely something to keep on the radar going into next week to see if we can get back up above this 8-day moving average on IWM, get back above the 17-day moving average especially, into this area and potentially break that resistance, or are we just going to roll back over and that 200-day moving average is going to be going up every single day next week. Where are we going to finish Friday in relation to that moving average? You're going to be back above it, which means you're probably going to have to be above all these lines too, and good. Or are we going to be back below it because it's going to be, like I said, at its current pace by next Friday, which would be what, August the 27th. That moving average is going to be right. That 200-day moving average is going to be right there. So we'll kind of see whether or not we end up above that or not. If I draw this line here, kind of draw kind of at the same angle, and then draw this line coming down at that same angle, and it's going to be a little bit of a curve, but kind of gives you an idea that if we were kind of end up here, we'd still be between the 30 and the 200. So we're either going to be above all these lines next Friday or below the 200-day moving average again. And I actually lean more towards that side of things, so I'm not really buying this bounce very much. But obviously you can see there's a possibility we can get back up and start testing this 50-day moving average again, which will probably be kind of in this area by the time we get to that point. So maybe up into this spot if we have a really good bounce like we've seen in past post-expiration moves. You can see we had a really good bounce on all of those. Okay, one last chart, a couple last charts here. Let's look at the 4-week range. There's the S&P. Look at that. We're really close to we're probably a couple of days away from getting a new low point here, a new low tag. But you also see how quickly we are back up to the high tag. That's how tight the range is. IWM did get a new low tag yesterday, and we're not anywhere close to a new high. And that high is not going to be dropping anytime soon either. And that low is not going to be moving up anytime soon either. So that's our gap for now. We have a bearish Arun crossover. So the question now is the red line going to stay up, or is it going to start coming down and the green line breaks back up to 100 before it gets to 0? I don't think so. I think the most likely scenario is the red line stays up, goes up and down, something like this, until the green line gets to 0. Then we'll see what happens at that point. And that by that point, we might be in bearish pullback mode, broadly speaking. So it might be a little bit of time. The other thing to keep an eye on is the VIX. The VIX did come back down as we thought it would yesterday. We were talking about it in my trading room on Thursday. We did come back down to not extreme low levels, 80%, but pretty close considering that we were, we got all the way up to 22, almost 23. In fact, I think we did hit a 23 print, 23.36 we hit as a high point. So considering that we got up to over 20 or 23, we are back down to almost extreme lows again, just like that. But the key to watch on the VIX here, when you break above the 200, its 200-day moving average, is it, you expect that it will come back down below it, which it did. Now the question is, will the 50-day hold? Because in other intermediate declines, the 50-day holds. So you can see, we got above it, we came right back down below it. That happens every time. We've been looking for that same thing. But you see also it breaks the 50-day within a few days. It breaks the 50-day within a few days. It breaks the 50-day within a few days. We are just a few days, maybe a day or two away from breaking the 50 again. If we can't, then we know, and we get bounced back above the 200, then we know there's a good chance that we might be, that this is our pullback there. So we're going to find out really quickly next week whether or not. I kind of thought that we had bounced back up today. We were pretty oversold on Thursday. I kind of thought we'd bounce, especially since we came off the lows on Thursday into the close. It was pretty obvious we were going to bounce up today, and we talked about that, like I said, in our class. Now there is a much bigger, not so obvious what's going to happen next week, and I actually lean towards volatility holding these lines for support and bouncing back up and following the rest of the market, starting to follow the trend of all these other risk asset classes, including small cap stocks, into more of a risk off mode. All right, we're going to take a look at some of the other asset classes and how they performed here and how they finished the week. But before we do that, I want to invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button, pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, that you want us to do another video again Monday. Quick way to give us feedback if you like our videos. If you don't like them, of course, you don't have to click on anything. But if you do like them and you want to let us know, give us one click down there on the thumbs up. It goes a long way for us. We really appreciate it. And you can do it right now while you're watching. Also, comment down there. What did you get out of the video today? What stood out to you? What questions, what comments do you have about anything I discussed or any charts I showed? Just post those comments down below. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. All of our free subscribers get a unique offer to be able to check us out. So subscribe there to get that offer. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there, at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right. Our Market Outlook live video I do every day. I do the Market Outlook. So we did one today at 3:30 Eastern Time. This is where you see it. You click on this image, or you can come up here and click on Market Outlook Live Trade Review. I review all trades that we've put on previous Market Outlook videos to see whether we should stay in them or get out of them. We also take a look at today's trade idea that you'll see at the end of the video today. We've already placed it before the market closed today. We did it during that video. So check that out. You can see over here too all of our upcoming trading rooms and Q&A sessions. Our trading rooms are and our Market Outlook live videos are available for all of our paid subscribers. Our premium subscribers get access for less money per month. In addition to that, our premium subscribers can also get access to our class forums, as well as our more message boards, as well as all of our premium tools and resources. Come down here on the bottom, click on this heart. It opens up a new tab. Hit that like button there. Also click on this thumbs up icon, opens up another new tab. Hit that like button as well. Again, the more you do that, the more our content will be seen by all of our followers. So that's why we ask for it all the time. We appreciate those who do click on those likes. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here. All right, let's jump back to the charts now, and let's take a look at some of the major asset classes and how they've performed here over this past week. So let's come over to here August, and we'll just go to the week that was. Take a look at the 5-minute chart. So you can see going into today, the dollar was up significantly this week. Long-term bonds was up significantly this week. Gold was outperforming even though it was kind of flat. It's hard for gold to be up too strongly when the dollar is up as strong as it is. But it was still outperforming all these other equity asset classes. You can see at the very bottom, the worst this week had been emerging market stocks, small cap stocks, commodities. I mean, that is risk off right there. Those are the riskier, quote unquote, riskier asset classes. QQQ is not one of the considered those. QQQ, in fact, has been considered more of a safety trade. Now, granted, not outperforming bonds or gold, but at least it's outperforming all these other equity asset classes. Then you can see today why we rallied like we did. I mean, QQQ and SPY rallied back up to a 0.5% drop. IWM finished the week still down 2.5%, so that's how much it was down. But you notice that was the only one of the three things that were down for the week. It was the only one of the three asset classes that rallied today. Everything else, emerging markets stayed down. Commodities went down more. They were down 6%. And you can see, you think, okay, well, if this was risk on, then bonds should be dropping because they were up. The dollar should be dropping because it was up, and gold should be dropping. But they didn't. They finished right about where they were. So that kind of shows you a lot of what, of how really risk on we were today. It was more of an oversold bounce of U.S. equities really only. If you take a look at these different asset classes, and you say, okay, well, I mean, when you associate things with risk appetite, you associate the euro because the dollar on the other side of this trade would be associated with safety. You associate crude oil. I mean, look at the drop in crude oil. Look at the drop in silver. Look at the drop in copper prices. Dark pink shading. Emerging markets. Dark pink shading. Red line. The 10-year bond. Dark pink shading and a red line. Even developed markets and global stocks in particular, which is what VT, even they have light pink shading and a red line. Bitcoin is the only asset class that's been associated with this risk trade in the past. Has been more associated with long-term bonds and gold and the dollar, which Again, if the euro is dark pink shading in a red line, that means the dollar is dark green shading in a green line. So, all of these looking like the risk trade is still pretty bullish. The only thing that's not is remember too, IWM. When you look at SPY, IWM is also dark pink shading. So when you look at this, you would think that we are in an exhale right now. We are in a pullback. But because of the NASDAQ 100 is keeping SPY afloat. And so that's why the one area of the markets, broadly speaking, that maintains this bullish posture is the S&P 500. Everything else is not showing that same kind of risk appetite, especially when you look at commodities. Just really getting hammered here. Look at gasoline prices. Look at the sharp drop in gasoline. Look at the sharp drop in heating oil. Look at the sharp drop in crude oil. Look at the sharp drop in silver and platinum and copper. And look at the sugar down here and corn rolling over. I mean, these especially up here are associated with growing economies. This is not necessarily the most bullish of charts. These are all dark pink shading and red lines. Only natural gas is kind of maintaining a yellow line there, and gold is flat at best, because again, this is more safety, considered safety. If you look at a global aspect of how these are performing, you can come down here and see the major economies, and again, dark pink shading and red lines. Dark pink shading. I mean, Korea is associated with China. It's got a very strong link to China, but it's also a reflection of global economic expectation, economic growth expectations. That doesn't look too hot, and Japan's not doing so well, even though it did get a cluster there. And you can see Europe had been pretty bullish up into these clusters, but then look at the drop this past week in a lot of these European areas, and you can see Brazil bouncing back up today, but still dark pink shading and red line. So again, this is hardly a kind of a risk-on pattern here from a global perspective. It is very, very, this risk appetite is very limited right now, and is very limited to one particular niche of the market, which is large cap tech. In fact, if you look at it this way, from a U.S. perspective, here's all the different U.S. Equity asset. I mean, there's more than this, but in general, you can see you got dividend stocks, you got value stocks, you got growth stocks, you got large cap, small cap, micro cap, and mid cap. And look at the only two that are rotating into the green. And really, SPY is not really rotating at all. It's just kind of stuck there. It's large cap and large cap growth. Whereas down here, you have value and small cap. And another way of looking at this is with this chart here, growth, value, and size. I mean, look at what we have going to top to the right: mid cap growth, large cap growth, U.S. growth, large cap, all moving up to the right. Small cap growth making a little bit of a run, but still very bearish from a relative strength standpoint. Everything else, look at the direction they're all heading. This is insane. And again, these have been associated. Value, incidentally, and small caps have been associated with risk appetite. And lately, large cap and growth has been associated with safety. And fortunately for the U.S., they happen to be the largest market caps in the U.S. So as investors move to safety, they're actually pushing stocks higher, because the stocks with the highest market caps are the safety right now, instead of the other way around, which is usually value ends up being the safety because of margin of error, margin of safety, and all of that. They've already gone down the most. They have lower valuations. That's what the market's looking for right now. The market's looking for known quantities, solid track records, good growth, lots of cash, and that's what you see in a lot of these large cap tech names. Even if their valuations way more than show. I mean, again, you look at the Schiller PE, and we're almost up to 40 again. I mean, to get above 40 was just so insane at the end of 99 going into 2000. You'd think that we'd never get there again. And lo and behold, here we are just, 20 years later, and we're almost right back up to those levels again. Now let's take a look at the sectors and how they've been performing. So let's pull up, it's right here. sectors. Well, we pull up the 12 grid first. And again, discretionary, like technology is doing great, even though it did get a cluster today. And that's kind of what's leading a lot of this. You can see financials, industrials, materials. This almost looks just like the European markets, right? They had a good little rally here, but then not a really good week at all. They've all really kind of pulled back. Look at energy, kind of hit resistance, pull back. Your safety trades look great, which is interesting because these are all safe havens down here. And so right now is XLK. You can almost throw XLK down here at the bottom, and that's a safe haven for us. But all these other asset classes, including consumer discretionary, that's a pretty bearish chart in fact, that's the most bearish it's been in quite a while to see consumer discretionary down to those levels. You can see that we did break the 17 and the 30 at the same time. Then we broke the 50, and we've been staying below the 50. We've been well below the 8 and well below the 17 to the point where they're starting to fall down now. They've got a good margin of safety because there's not, you've got a good support here, 171.5 and 170. So lots of volume. It's not going to go down very much. Not nearly the same as, say, like financial stocks. If they get hit hard, you can see they don't have a good margin of safety. If you were to draw this line and put it all the way up to the high here, you can see that if we break that 23% level, which is a couple touches there, but if we break those touches, our biggest volume node's right directly below us, right at that 30-day moving average and the 50. If you break both of those, then there's not a lot of volume until you get down to, you get your 38% retracement level in the 200-day moving average. So not the same, right? Discretionary has a much better margin of safety than what financials, and for that matter, other areas like industrials. Look at that. That's a horrible looking chart. Like from a margin of safety standpoint, like if you break that 23% line, then there is nothing to hold this thing up until you get down to its 62% retracement. $14 away or $16 away. That's not a good drop for XLI, and again would be a kind of a sign of risk aversion. So that's kind of why, this is great that the SPY has been on this now nearly 10-month long intermediate rally, but it is really like the only things keeping it up is actually risk aversion as investors kind of work their way towards large cap tech growth as their safety mechanism, as the best place for them to feel like out of all the places, emerging markets, developed markets, commodities. Everything is pointed to investors seeking safety from these other risk asset classes into that area. And fortunately for the SPY, that happens to lift SPY because of the market cap weighting. Those happen to be, especially XLK, the biggest sector from a market cap weighting standpoint. All right, so that brings us to our trade idea of the day. And it's actually in another area of the market that is reflective of economic growth expectations, has a pretty strong link to Korea, and that is semiconductors. And the stock in particular we're going to take a look at today. Excuse me. Let me get the right chart up here. The chart we're going to look at today is Applied Materials. So let's pull up Applied Materials here. And you can see, again, very strong day today, but not for Applied Materials. It had its earnings announcement. It's down 1.5%, where everything else was up. The intermediate posture is in bearish territory. The short-term sentiment lines cannot get going. They can't get above the market sentiment line, much less in the bullish territory. We are 6% below the moving average, the 30-day moving average down there. This is a chart that's in its own little bearish pullback right now, and today didn't help it. And this is a really important segment of the market. You can see, it's got the red line on this 10-week moving average. We got a bearish candle. We're going to get a bearish candle next week too. You look at some of these other oscillating indicators. You can see, we are, even though with the bounce up today, we're still near 30 on the negative index. We're still well below 20 on the positive, so we still have a rising ADX. The Ichimoku cloud had been pretty bullish. We're in a relatively noisy pattern now, and you can see we're flirting with breaking below the cloud. Yesterday going into earnings, we were below it barely. We got back above it barely, and now we're back below it. If you take a look at the the 3 green arrow chart, but looking at the 2 line versions, today's move got us up to the open at the 8-day moving average and hit it and reversed back down below it, which is not a good sign. And we got plenty of room between the 50, which is above all these lines, and the 200 for us to kind of work our way down towards that volume area. And you can see that's not a very strong volume area anyway, and you have a very strong volume area up above us right now. If you take a look at the RSI and the CCI, you can see we're still below 40. We have been. We're still easily in the lower half, but you see how we've been flirting with that minus 100 area. You look at its Bollinger Bands. You notice too that we are below this volume area up above us here. We are in the lower quartile of the bands, have been. In fact, if you look at the Keltner channels in conjunction with those bands, we have this bearish pattern where we are trading between the Keltner channel and the band and pointing and falling, which are both going to the downside. That's, I mean, nothing's 100%, but if you're looking for, what pattern would show a bearish trend, that's it. This, opposite would be true for a bullish trend, but that's what you'd see when they're both falling and you're trading in between them. That is a, a bearish trending play pattern for that particular stock. So you can see, there's obviously bearishness here, but still, there's a level of support. That's we got down to this 115 area. We got strong resistance above us. So what we did was we pulled up Applied Materials and we said, okay, let's take a look at selling the 130 and buying the 135 call option here. So what that does is it gives us a as long as we stay below 130, then that's what we want to do. You can see we position size normally because we don't have to worry about earnings. We ended up getting in at about, I don't know, let's see here. When did we get in here? Maybe put this back to 0. We got in at, what, $3.53, $1.53. So we got a pretty decent credit for a $5 wide spread. There's where our break even is. When I put that break even on the chart, especially on the intraday chart, you notice as long as we stay below that gap and these highs and that point of control, then it doesn't have to go down. It just has to stay down here. And obviously there's a lot of resistance above us, so it's a very good chance that we will stay down below here. And again, if we go down further, and if we go down, directional basis, then if we can get 50% of max gain quick, then I can use that capital within this next week on another trade, if we so choose, before we get to that 20-day window by the end of next week. If not, then let's see, I'm trying to make 459, so that's what I'm willing to lose. If it does break out to the upside, and it would take a breakout, we'd have to get all the way up here to 136, 136, which is way up into this spot. So we'd have to really break through this gap and break into the upper half. That would be quite the break to the upside. Then we'll take, $450 loss, and that's perfectly acceptable considering the probabilities of this and what we're trying to get out of it. Alright, so that wraps us up for today. You've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. I'll reply to anybody else's threads. And let's keep this conversation going in between videos. Remember to subscribe to our YouTube channel as well as to our website at marketscholars.com. Hit that thumbs up icon. Like us on Twitter and Facebook as well. Comment on the video. Have a great weekend, everybody. And we'll see you all on Monday.